As your eyelids grow heavy and the world outside begins to soften its edges, a different kind of journey awaits. This isn't just another bedtime story to lull you into unconsciousness. It's an invitation to explore the unseen currents that shape our reality, even as we rest. Think about it. While you drift into dreams, empires rise and fall, fortunes are amassed and lost, and the very fabric of commerce continues to weave its intricate tapestry. This narrative is designed to be your guide through those hidden realms, a whisper of wisdom that unfolds as you relax, revealing how prosperity and progress are constant, dynamic forces, perpetually in motion, much like the stars in the night sky. We often associate wealth with the daylight hours, with bustling markets and demanding workdays. But what if the most profound growth, the most significant accumulation, happens when we're least aware of it? What if the secrets to enduring abundance are best understood in the quiet stillness of the night, when the mind is open to subtler influences? This unique bedtime story delves into that very paradox, exploring the timeless relationship between rest and riches, between stillness and ceaseless motion. It's about understanding that the passage of time, our most valuable yet often overlooked resource, is also the most potent ally of any significant endeavor, especially those related to building and sustaining wealth. We tend to believe that active effort, the visible hustle, is the sole determinant of financial success. Yet history, folklore, and even the fundamental laws of nature whisper a different truth. That patience, consistency, and the quiet, relentless march of time are equally, if not more, crucial. This story seeks to connect you with that fundamental understanding, not through dry lectures or complex financial jargon, but through captivating tales and insightful observations that resonate on a deeper, more intuitive level. Imagine being transported to ancient lands, where the gleam of freshly minted gold coins was a tangible representation of power and influence. Then, picture yourself gliding through the ether to the modern digital age, where wealth flows through invisible channels, a constant, humming presence in the background of our lives. The common thread, the unbroken line, is a persistent, often unnoticed, growth that occurs when we allow certain principles to work their magic. This is a narrative designed for the curious adult mind, one that appreciates the depth of history and the mystery of human endeavor. It's about awakening a dormant sense of abundance within you, not by demanding action, but by fostering profound, relaxing realization. As the soothing cadence of the narration washes over you, the aim is to cultivate a sense of security and ease, a quiet confidence that prosperity is not merely a fleeting phenomenon, but a fundamental aspect of the universe's ongoing dance. The allure of gold, the pursuit of prosperity, the very concept of accumulation, these are ancient human preoccupations. Yet, the methods and manifestations have transformed dramatically over millennia. This story serves as a bridge, connecting the tangible wealth of ages past with the abstract, yet equally potent financial landscapes of today. It's about recognizing that while the world around us may seem to pause when we close our eyes, the forces that generate and grow wealth never truly sleep. They are as tireless as the tides, as consistent as the turning of the earth. Our journey will explore how this perpetual motion manifests, from the slow, deliberate drip of interest on a forgotten deposit to the lightning-fast transactions that shape global markets. It's a perspective shift, an opportunity to absorb, through the gentle immersion of a spoken narrative, the idea that wealth can indeed grow in the background of our lives, nurtured by time, patience, and understanding of its inherent momentum. This is a story designed to be absorbed not just by the intellect, but by the very essence of your being, leaving you with a subtle yet profound shift in perspective, a quiet assurance that the universe is always working, always creating, and that you, too, can align with that natural flow of abundance. As you settle in, allow the subtle hum of this narrative to become the soundtrack to your unwinding. This is your time to disconnect from the day's demands and reconnect with a deeper sense of wonder. We'll be peeling back layers of history, myth, and financial evolution, not to overwhelm you with facts, but to reveal patterns, to highlight the enduring principles that have governed human prosperity since the dawn of civilization. Think of it as a gentle exploration of the concept that true wealth isn't always about the loudest bang or the most visible effort. Sometimes it's about the quiet, unseen processes, the slow burn of compound interest, the strategic foresight of ancient merchants, the patient cultivation of resources over generations. The very act of listening, of allowing yourself to be guided through these tales, is an exercise in trust and surrender, qualities that are, in their own right, foundational to building lasting abundance. This story doesn't offer quick fixes or get-rich-quick schemes. Instead, it offers a different kind of richness. The richness of understanding, the wealth of perspective, and the deep, resonant calm that comes from knowing that the world and its potential for prosperity continues to spin even when you are at your most peaceful and serene. The true magic of this Historia de Dormir lies in its ability to subtly reprogram your subconscious. While your conscious mind relaxes and absorbs a narrative, your inner self begins to process the underlying messages of constancy, patience, and inevitable growth that time facilitates. You will discover how civilizations built empires on the bedrock of foresight and the slow, steady accumulation of resources. You will learn about the whispers of legends that speak of hidden treasures and the patient guardians who awaited the opportune moment for their revelation. These aren't mere fables. They are allegorical representations of fundamental truths about how value is created, preserved, and grown over extended periods. This narrative is designed to plant seeds of understanding, to cultivate an internal environment where the concepts of financial well-being are not viewed as a struggle, but as a natural, flowing process. As the story unfolds, you'll find yourself becoming more attuned to the subtle ways in which wealth operates, even in your own life. The objective is for you to drift into sleep with a mind that feels both intellectually stimulated and profoundly at peace, carry with the quiet confidence that abundance is a constant, and that its growth is an ongoing, ever-present phenomenon, much like the turning of the planet itself, happening with or without our direct, conscious supervision. Now let your shoulders relax. Let the breath deepen. As the narrative begins, picture yourself embarking on a voyage that transcends time and space. We start not with the spreadsheets and stock tickers of the day, but with something far more elemental. The very earth beneath our feet and the precious metals it held, guarded by ancient suns and patient stone. Imagine the immense effort, the sweat and toil that went into extracting the first specks of gold, the raw material that would eventually become the bedrock of economies, and the symbol of ultimate value. Yet, even then, it wasn't just the mining that mattered. It was a journey from those mines, the caravans that snaked across vast deserts, the ships that braved treacherous seas, all carrying this gleaming promise. This was the dawn of trade, the nascent pulse of a global economy, driven by the desire for something rare and beautiful. The Romans, with their legendary engineering and insatiable appetite for expansion, understood this intrinsically. Their legions marched not just for conquest, but to secure mines, to control trade routes, and to mint currency that would fuel their colossal empire. Picture the orderly mints, the rhythmic clang of hammers shaping metal into coins bearing the emperor's profile, a tangible representation of power, stability, and the promise of future prosperity. But even this empire, seemingly eternal, eventually fractured. What happened to the gold? Did it vanish? Or did it simply change hands, flowing into new treasuries, financing new ventures, continuing its silent work? This is where our story begins to weave its threads, connecting the visible might of ancient empires to the less apparent, but equally potent forces that shape our financial destinies. We'll explore how this metal so coveted became a silent partner in the grand play of history, influencing decisions, funding explorations, and ultimately shaping the very world we inhabit. And as we traverse these historical landscapes, remember the underlying theme: the relentless motion of wealth, a force that adapts, transforms, and continues to grow, even when the civilizations that sought it fade into legend. This is your invitation to understand that the river of riches never truly stops flowing. Centuries later, as the great Roman Empire waned, its meticulously crafted trade routes didn't simply disappear. They evolved, becoming the arteries for a new era of commerce. Think of the Byzantine Empire, inheriting and adapting Roman systems, and later the rise of the Italian city-states like Venice and Genoa, becoming titans of maritime trade. Their galleys, laden with spices, silks, and precious metals, were more than just ships. They were mobile banks, carrying potential for immense wealth across the Mediterranean. Venice, in particular, became a financial powerhouse, its merchants mastering the art of credit, bills of exchange, and nascent forms of banking. They understood that money itself could generate more money, a concept that would form the very basis of interest and investment. Imagine the hushed counting houses, the ledgers meticulously filled with transactions that span continents. While the populace might have seen the outward signs of Venetian wealth, the opulent palaces, the grand canals, the true engine was a sophisticated financial machinery operating behind the scenes. This era also saw the seeds of formalized lending institutions. The precursors to modern banks began to emerge, not as places to merely store wealth, but as facilitators of trade and growth, lending capital to ambitious ventures in exchange for a share of the profits or a promise of repayment with interest. It was a crucial shift. Wealth was no longer solely about hoarding tangible assets like gold and silver, but about leveraging capital to create more capital. The concept of time as money took on a profound new meaning. Money, when put to work, could indeed grow while its owner or the lender slept. This was the birth of compound growth, a subtle but incredibly powerful force that would, over the centuries, dwarf the value of the initial principle. Did you ever stop to consider that the very foundations of our modern financial systems were laid centuries ago, not by algorithms and computers, but by shrewd merchants and pragmatic bankers who understood the timeless power of lending and long-term investment? This is a pivotal moment in our story, where the tangible gleam of gold begins to meld with the abstract concept of financial instruments, creating a more dynamic and resilient form of wealth. As these systems grew more complex, so too did the potential for wealth to multiply, often in ways that were invisible to the casual observer. The merchant in Venice might have been sleeping soundly, his fortune growing not just from the goods he had sold, but from the interest accrued on loans he had extended to others embarking on their own risky but potentially lucrative voyages. This quiet accumulation, this persistent growth, is a theme that will echo throughout our narrative, underscoring the idea that prosperity is often a marathon, not a sprint, a testament to patience and the relentless passage of time. As the centuries rolled on and the age of exploration opened up new worlds, the pursuit of precious metals became an obsession that reshaped continents. The Spanish galleons, laden with silver from the mines of Potosi and Bolivia and gold from across the Americas, were floating treasuries, carrying unimaginable wealth back to Europe. This influx of bullion didn't just enrich a few. It fundamentally altered the global economy, fueling empires, financing wars, and triggering what historians call the price revolution, a dramatic rise in prices due to the sheer volume of new money entering circulation. Imagine the sheer scale of it. Ships arriving year after year, disgorging mountains of silver coins, each one a testament to the Earth's hidden riches and the relentless drive of human ambition. Yet, the story isn't just about the extraction and transportation of gold and silver. It's about what happened to that wealth. A significant portion found its way into the hands of monarchs and financiers who then reinvested it, often in ventures that further expanded trade, sponsored scientific discovery, or funded the burgeoning industries that would characterize the Industrial Revolution. The concept of wealth creation began to shift from mere accumulation to active deployment. Think of the Dutch East India Company, one of the first multinational corporations, which raised vast sums of capital through issuing shares to the public. Investors, from wealthy merchants to ordinary citizens, bought these shares, effectively lending their money to the company in exchange for a portion of its profits. This was a revolutionary idea, allowing wealth to be pooled and directed towards large-scale enterprises, with the expectation that time and strategic management would yield substantial returns. The gold and silver extracted from the New World were not merely hoarded. They were circulated, leveraged, and reinvested, creating a multiplier effect that generated wealth far beyond the initial value of the metals themselves. This period highlights a critical understanding. Wealth isn't static. It's a dynamic force that thrives on movement, on investment, and on the patient calculus of risk and reward. Even as these vast fortunes were being amassed, the underlying principles of compound interest and strategic reinvestment were silently at work, ensuring that the wealth generated continued to grow, often at an accelerating pace. It raises a compelling question, doesn't it? How much of the progress and prosperity we enjoy today is built upon the foundation of those early, often brutal, but undeniably significant flows of precious metals and the financial innovations they spurred? As these flows continued, the very notion of wealth began to evolve, becoming less about the weight of gold in a vault and more about the potential for capital to generate further capital, a process that truly works while we sleep. The Industrial Revolution, spanning the 18th and 19th centuries, represented another seismic shift in how wealth was created and accumulated. It wasn't just about finding more gold or silver. It was about harnessing new sources of power, steam and electricity, to transform raw materials into manufactured goods on an unprecedented scale. Factories, powered by these innovations, became the new engines of wealth, churning out textiles, machinery, and countless other products that fuel global trade and dramatically increase productivity. Think of the sheer audacity of it. Building colossal structures filled with complex machinery, employing thousands, and producing goods that were once the exclusive domain of skilled artisans. This era saw the rise of industrialists and financiers who amassed fortunes that dwarfed those of previous generations. Figures like Andrew Carnegie, John D. Rockefeller, and the Rothschild family built empires not just on mining or trade, but on innovative business models, vertical integration, and a keen understanding of how to leverage capital for massive expansion. The stock market, which had been developing for centuries, truly came into its own during this period. Companies began to issue stocks and bonds in vast quantities, allowing investors from all walks of life to participate in the growth of these industrial giants. This meant that wealth could be generated not just through direct ownership or lending, but through owning a piece of the future, through investing in the success of these burgeoning enterprises. The concept of passive income took on a whole new dimension. An investor, perhaps sitting in their study, could own shares in a textile mill in Manchester or a railroad company stretching across the American plains, and profit from their operations as they ran day and night. The profits from these factories, reinvested in new machinery, new factories, or new ventures, created a powerful cycle of compounding growth. It wasn't always a smooth ride. There were booms and busts, panics and recessions. But the underlying trend was undeniable. The capacity for wealth creation had exploded, and a significant portion of this growth was happening, in essence, while people slept, driven by the continuous operation of machinery and the tireless engine of capital markets. This period really cemented the idea that wealth could be built through systems and structures, not just through individual exertion. It also underscored the power of patience and long-term vision. Those who invested in promising industries and held their investments through economic cycles often saw their wealth grow exponentially over decades. It makes you wonder, doesn't it, if the seeds of today's massive corporations and technological advancements were first sown in the smoke-filled air of those early factories by individuals who understood the simple, yet profound, power of letting invested capital do the heavy lifting over time? As we transition into the 20th century and beyond, the nature of wealth creation continued its rapid evolution, moving from the tangible assets of factories and mines towards the intangible realm of information, innovation, and financial engineering. The post-World War II era, in particular, witnessed an explosion in technology, globalized markets, and the development of sophisticated financial instruments. Think about the advent of the computer, the internet, and later, mobile technology. These innovations didn't just change how we communicate or entertain ourselves. They fundamentally reshaped entire industries and created entirely new avenues for wealth accumulation. Companies built on software, data, and digital platforms began to command valuations that would have been unthinkable just a generation prior. The stock market became even more central, with the rise of mutual funds and later, index funds, making it easier than ever for individuals to participate in the broad growth of the economy. This democratized investing, allowing ordinary people to benefit from the compounding power of the market over the long term. The concept of passive investing truly came into its own. By simply investing in a diversified portfolio of stocks or bonds and letting time and market forces work their magic, individuals could build significant wealth without needing to actively manage individual companies or trades. This is the epitome of wealth growing while we sleep. Your money, invested in a global economy that operates 24/7, is constantly working, generating returns that are reinvested, thereby compounding your initial investment. Furthermore, the financial sector itself became a massive engine of wealth creation. Investment banking, hedge funds, private equity firms. These entities specialize in managing, deploying, and generating capital, often on a colossal scale. They employ complex strategies, leverage sophisticated algorithms, and operate across global time zones, ensuring that capital is constantly being moved and put to work to maximize returns. The rise of the digital age has further accelerated this. Cryptocurrency, blockchain technology, and decentralized finance are the latest frontiers, pushing the boundaries of what we understand as wealth and how it can be generated and stored. While these are often characterized by volatility, they represent a continuation of the trend towards intangible assets and digitally native forms of value. It prompts a profound reflection. As the world becomes increasingly interconnected and technologically advanced, how does our understanding of work, effort, and reward need to adapt? If wealth can be generated through smart investments, technological innovation, and the efficient allocation of capital in a global, always-on economy, what does that mean for the traditional notions of labor and value? It means that the ability to let your money work for you, to harness the power of time and compounding, and to participate in the global economic machine has never been more accessible or more potent. The secrets of wealth accumulation are no longer solely guarded by ancient kings or shrewd industrialists. They are embedded in the very systems and technologies that underpin our modern world, operating continuously, silently, and powerfully, even as you drift into a well-deserved rest. Consider this. The very act of rest, of allowing yourself to disengage from the constant demands of the day, is a powerful, yet often underappreciated, component of building lasting abundance. While you are asleep, your body and mind repair and rejuvenate, preparing you for challenges and opportunities of a new day. Similarly, when you engage in sound financial practices, investing wisely, allowing your assets to grow, and benefiting from the relentless power of compounding interest, you are essentially allowing your wealth to undergo its own form of essential regeneration and growth. This isn't about active moment-to-moment effort. It's about setting up the right conditions and then trusting the process. The historical journey we've taken, from the glint of ancient gold to the digital streams of modern finance, reveals a consistent truth. Wealth has always sought to move, to grow, and to multiply. The caravans, the galleys, the factories, the servers, they are all manifestations of this fundamental drive. And the most powerful engine in this entire equation? Time. Time allows for the snowball effect of compound interest, for the patient growth of businesses, for the strategic deployment of capital across global markets that never truly close. As this Historia de Dormir draws to a close, I encourage you to reflect on this continuous motion. Think about how, even as you close your eyes, the world outside is spinning, markets are trading, and the fundamental forces of wealth creation are in play. This awareness, absorbed in a state of relaxation, can foster a deep sense of security and optimism. It's a realization that abundance isn't just something you chase. It's something that can grow organically, patiently, and powerfully, provided you align yourself with its natural rhythms. Perhaps, as you fall asleep tonight, you'll carry with you a newfound appreciation for the silent, ceaseless work of time and capital, a general understanding that prosperity is a journey that continues, unfolding its potential even in the deepest of dreams. What subtle shifts might occur in your own financial mindset if you truly embrace the idea that growth can happen during periods of rest and patience? Consider this a quiet seed planted, ready to germinate with the morning light. The modern era, particularly the latter half of the 20th century, introduced a profound shift in how value is perceived and generated. Beyond the tangible assets like gold, silver, and even industrial machinery, we entered an age where intellectual property and digital assets began to rival, and in many cases, surpass them in economic significance. Think about the seismic impact of software development. A programmer's code, an intangible creation, can form the backbone of a multi-billion-dollar company. This transition from physical to virtual capital fundamentally altered the landscape of wealth creation. Consider the concept of network effects, a phenomenon that truly blossomed with the advent of the internet. The more users a platform acquires, the more valuable it becomes to each individual user, creating a self-reinforcing cycle of growth that can occur with remarkable speed, often during hours when most people are inactive. For instance, social media platforms or online marketplaces gain exponential value as their user base expands, a process that continues incessantly, regardless of individual sleep cycles. This is wealth that is built not just on capital or labor, but on connectivity and collective participation. Furthermore, the evolution of financial markets themselves has introduced layers of complexity and opportunity previously unimaginable. The rise of algorithmic trading, for example, represents wealth generation operating at speeds and scales that transcend human limitations. Sophisticated computer programs, designed to execute trades based on complex market analyses and predictions, can operate around the clock, capitalizing on minute price fluctuations across global exchanges. This automated financial activity means that capital is constantly being deployed, reallocated, and grown, even in the dead of night. It's a testament to how human ingenuity has created systems that operate independently, continuing the accumulation process tirelessly. Imagine the intricate dance of these algorithms, reacting to global news, economic data, and trading patterns instantaneously, all while the world sleeps. This represents a significant departure from earlier eras, where wealth accumulation was more directly tied to physical presence, manual labor, or human-mediated transactions. Consequently, the potential for growth is no longer constrained by the limitations of the human workday. Another crucial layer in this ongoing narrative is the growing importance of data as a form of capital. In today's digital economy, the ability to collect, analyze, and leverage vast amounts of data is a primary driver of corporate value. Companies that excel at understanding consumer behavior, market trends, and operational efficiencies through data insights often achieve significant competitive advantages and, consequently, substantial financial gains. This data-driven wealth creation operates continuously as information is gathered and processed 24/7. Consider how online services constantly refine their offerings based on user interactions, or how logistics companies optimize routes in real time using sophisticated tracking systems. The value derived from this constant flow of information translates directly into economic gains, a silent engine of prosperity that doesn't adhere to any particular time zone or human schedule. This signifies a shift where the raw material for wealth generation is increasingly abstract, derived from information and insights rather than solely from physical resources. Conversely, the concept of sleep capital, the idea that periods of rest and inactivity can actually be productive from a wealth-building perspective, gains traction in this context. By investing in well-diversified assets, setting up automated savings plans, or establishing businesses that can run with minimal direct oversight, individuals can effectively harness the power of time and compounding during their inactive hours. It's about designing systems, both financial and operational, that continue to generate value without requiring constant, active human intervention. This requires a mindset shift, moving from a model of direct, hourly labor to one that emphasizes strategic setup, patient observation, and the leveraging of automated processes. Think about how a well-constructed investment portfolio, managed through automated rebalancing, continues to grow and adapt to market conditions, effectively working for the investor during sleep. This sophisticated interplay between human foresight and automated execution underscores the continuous, multifaceted nature of modern wealth generation. The persistent hum of global commerce doesn't merely affect financial markets. It influences the very fabric of innovation and creative industries, often in ways that unfold during periods of repose. Think about the world of scientific research and development. Breakthroughs frequently emerge not from the frenetic pace of a laboratory's busiest hours, but from moments of quiet contemplation, the serendipitous connections made when the mind is relaxed, or even during dreams. Consider the story of the chemist August Kekulé, who famously recounted dreaming of a snake biting its own tail, a vision that provided a crucial insight into the ring-like structure of the benzene molecule. This wasn't a result of direct, day-to-day experimentation, but a subconscious synthesis occurring during rest. Similarly, the development of complex software or intricate artistic creations often involves periods of incubation, where ideas gestated during active work mature and coalesce when the creator steps away, allowing the subconscious to engage with the problem in novel ways. This incubation phase, facilitated by rest, directly contributes to the ongoing generation of intellectual capital. Building on this understanding of creative incubation, consider the application of long-term, patient capital in emerging creative fields. Venture capitalists and angel investors are increasingly looking beyond immediate returns, recognizing that truly transformative artistic or technological innovations require extended development timelines. They are willing to fund projects, whether they are groundbreaking films, ambitious video games, or novel forms of digital art, knowing that the gestation period might be years, during which the value of the intellectual property steadily increases. This patient capital acts as a silent partner, providing a financial runway for creators to refine their vision without the pressure of constant, short-term revenue generation. The value accrues not just from immediate sales, but from a potential unlocked over time, the cultural impact, and the future licensing or adaptation opportunities that emerge from a well-realized creative work. This is a form of wealth creation that inherently thrives on patience and the passage of time, often benefiting from the creative energies that flourish when individuals are not under immediate operational stress. Furthermore, the decentralized nature of digital creation platforms now allows for continuous, global engagement with creative endeavors, independent of localized working hours. Artists can upload their work to online galleries or streaming services, making it accessible to a worldwide audience at any moment. Royalties and licensing fees generated from these platforms can accrue continuously, day and night, as consumers engage with the content across different time zones. A musician, for example, might release a track that gains traction organically, with streams and downloads contributing to their income long after the initial creative effort has concluded and the artist is resting. This model decentralizes value creation, allowing for passive income streams that are a direct result of prior creative output being continuously consumed and valued globally. It highlights how the sleep capital of the creator translates into active, ongoing financial returns from the marketplace. Conversely, the principle of accumulating experience capital in fields requiring deep expertise also benefits from this continuous, if indirect, growth. Consider a seasoned surgeon, a master artisan, or a leading academic. While their active working hours are finite, the collective knowledge and refined skill they possess represent a form of capital that continues to exert influence and generate value. Their reputation, built over years of dedicated practice, can attract more lucrative opportunities, consultancy roles, or speaking engagements, often scheduled during times when they are not actively performing their primary duties. This accumulated expertise becomes a valuable asset, a testament to patient dedication, which continues to yield dividends long after the direct effort has been expended. It's an intangible asset that grows with time and consistent application, demonstrating that not all forms of wealth are measured in monetary terms or generated during waking hours. Now, consider how this relentless global economic activity fosters a continuous growth of reputational capital, a subtle yet potent form of wealth that accrues over time, often while we are entirely unaware of its development. Think about how a company's consistent delivery of quality products or ethical business practices builds a reservoir of goodwill and trust within the market. This isn't something that happens overnight. It's a gradual accumulation, a testament to sustained effort and unwavering principles. Even during periods of perceived stagnation, or when a business might be undergoing internal restructuring, this underlying reputational asset continues to operate. It influences consumer loyalty, attracts top talent, and can even buffer the impact of minor setbacks. This earned trust becomes a powerful, albeit intangible, asset, enabling future growth and resilience. A brand that is universally respected for its integrity, for instance, can weather economic downturns more effectively than a competitor with a less robust public image, because its customers and partners are predisposed to remain loyal. This enduring trust is a form of wealth that compounds, not through financial transactions, but through consistent positive interactions and the passage of time, solidifying its value long after the initial actions that built it. Furthermore, observe the fascinating interplay between knowledge arbitrage and persistent wealth generation, especially in fields where information asymmetry is prevalent. In specialized sectors, such as advanced technology, niche finance, or emerging scientific research, disparities in access to and understanding of critical information can create significant opportunities for those who bridge these gaps. Individuals or firms that dedicate themselves to acquiring deep expertise in a particular domain and then apply that knowledge to solve complex problems or identify undervalued opportunities are essentially creating value where others see none. This process of acquiring specialized knowledge, honing analytical skills, and then strategically deploying that insight is akin to cultivating a financial asset that grows through continuous learning and application. Even when not actively engaged in a transaction, the growing depth of one's expertise serves as an ever-increasing advantage, a latent potential that can be leveraged at opportune moments. The very act of research, analysis, and pattern recognition even if it doesn't immediately result in a sale, contributes to the exponential growth of this unique intellectual capital, a form of wealth that is intrinsically tied to the tireless pursuit of understanding. Conversely, delve into the domain of intergenerational wealth transfer, a process that underscores the long-term, often dormant, growth of capital across generations. While the act of accumulation of wealth might cease with an individual, the established assets, be they financial holdings, real estate, or businesses, continue to operate and potentially appreciate under prudent management. The key here is not the direct effort of the original wealth creator, but the effective stewardship and strategic reinvestment by subsequent generations. Think about family trusts or endowments that have endured for decades, even centuries. Their value doesn't stem from the daily labor of their current beneficiaries, but from the initial capital's ongoing performance, its ability to generate income, and its strategic growth over extended periods. This represents a form of wealth that operates in a state of suspended animation from the perspective of active human effort, yet remains dynamic and productive, its value silently building through dividends, interest, and capital appreciation, testament to the enduring power of patient capital. Another crucial facet to consider is the concept of ecosystem development in the digital age, where platforms and their associated communities create sustained value independent of their founders' constant involvement. Consider the vast app stores, online marketplaces, or open-source software communities. While the initial platform might have required significant development effort, its ongoing value is largely driven by the continuous contributions of third-party developers, content creators, and active users. These external participants build applications, create content, and foster communities that enrich the platform, thereby increasing its overall utility and economic potential. This dynamic ecosystem continues to evolve and generate value around the clock, driven by a global network of contributors, many of whom are operating in different time zones, and during times when the platform's original creators might be at rest. This represents a form of emergent wealth, a collective economic engine that thrives on decentralized, persistent activity, showcasing how value can organically expand through network engagement over continuous periods. Now, let's explore how the relentless pursuit of efficiency optimization in the modern economic landscape creates a subtle yet continuous engine for wealth growth, often operating behind the scenes. Think about lean manufacturing principles or Six Sigma methodologies. These aren't just management fads. They represent systematic approaches to minimizing waste, reducing operational friction, and maximizing output from existing resources. Companies that successfully implement these strategies can achieve significant cost savings and productivity gains. This isn't about adding more hours to workday. It's about making every hour, every piece of equipment, and every employee's effort more impactful. Consequently, profit margins improve, and the overall value of the enterprise expands. Even if the workforce is operating on a standard schedule, the wealth generated here comes from smarter, more focused utilization of assets, a process that is continually refined and optimized, yielding incremental but substantial gains over time. Building on this, consider profound impact of supply chain resilience on long-term wealth preservation and growth. In an increasingly interconnected global economy, disruptions, whether from geopolitical events, natural disasters, or pandemics, can severely impact businesses. Companies that proactively invest in building robust, adaptable supply chains, diversifying their suppliers, and leveraging advanced logistical technologies are not just mitigating risk. They are creating a competitive advantage that translates into sustained value. This resilience ensures continuity of operations and revenue streams, even when external factors create turbulence. It's a strategic investment that allows businesses to weather storms and emerge stronger, a silent testament to the growth potential inherent in forethought and preparedness, operating continuously as a foundational strength. Furthermore, let's examine the concept of predictive analytics and its role in wealth generation through proactive decision-making. Businesses are now leveraging vast data sets and sophisticated algorithms to anticipate market shifts, customer behavior, and potential operational bottlenecks before they fully materialize. This foresight allows for more informed strategic planning, optimized resource allocation, and timely interventions. For instance, a retail company might use predictive models to forecast demand for specific products, ensuring optimal inventory levels and minimizing stockouts or overstocking. This proactive approach, driven by continuous data analysis, minimizes financial losses, and maximizes revenue opportunities, essentially generating wealth by preventing potential value erosion and capitalizing on anticipated market needs, operating ceaselessly in the background of business operations. Conversely, consider the role of automation in customer service and support. While often seen as a cost-saving measure, intelligent automation, through AI-powered chatbots and self-service portals, can also enhance customer satisfaction and loyalty by providing instant, 24/7 support. This improved customer experience can lead to increased retention rates, higher lifetime customer value, and positive word-of-mouth referrals. The wealth generated here stems not from reducing labor costs in isolation, but from creating a consistently positive customer journey that fosters loyalty and repeat business, a benefit that accrues continuously regardless of time of day. The subtle but constant improvement in customer relationships translates directly into a more robust and valuable business, driven by technology that never sleeps. Now, let us explore the burgeoning domain of behavioral economics and its intricate influence on wealth accumulation, a field that delves into the often irrational psychological drivers behind financial decisions. It reveals how subtle nudges, framing effects, and cognitive biases can significantly shape an individual's propensity to save, invest, or spend, often operating outside conscious awareness. Consider the concept of loss aversion, where the pain of losing a certain amount of money is psychologically more potent than the pleasure of gaining an equivalent sum. This bias can lead individuals to hold on to underperforming assets for too long, fearing the crystallization of a loss, thereby hindering the growth potential of their capital. Understanding these ingrained psychological patterns allows for the design of financial products and advisory services that subtly guide individuals towards more beneficial long-term strategies, effectively leveraging human nature to foster wealth rather than hinder it. Building upon this psychological foundation, we can examine the application of dynamic pricing models in various industries, which continuously adjust costs based on real-time demand, supply, and even external factors like weather or time of day. Think of ride-sharing services, airlines, or even energy providers. Their pricing algorithms are constantly in motion, optimizing revenue by capturing the highest price consumers are willing to pay at any given moment. This dynamic adjustment ensures that assets, be they car seats, airplane seats, or electricity, are utilized at their maximum economic potential, generating a continuous flow of revenue. This adaptive pricing strategy represents a sophisticated form of wealth maximization, operating ceaselessly to align market value with immediate availability, thereby optimizing the economic output of underlying resources. Conversely, consider the emerging impact of regenerative finance, ReFi, a movement that seeks to align financial incentives with ecological and social well-being. ReFi initiatives often leverage blockchain technology to create transparent and accountable systems where financial returns are linked to positive environmental or social outcomes, such as carbon sequestration or community development. This approach redefines wealth not merely as monetary accumulation, but as a creation of sustainable value that benefits both investors and the broader ecosystem. Investments in ReFi projects can generate returns through tokenized rewards, participation in decentralized governance, or the inherent value appreciation of assets tied to verifiable positive impact. This represents a new paradigm where financial growth is intrinsically linked to the regeneration of natural and social capital, creating a different, more holistic form of enduring prosperity. Furthermore, let us delve into the strategic deployment of intellectual property licensing as a continuous wealth-generating mechanism. Beyond the initial creation of a patented invention, a groundbreaking piece of software, or unique artistic work, companies and individuals can generate ongoing revenue streams by licensing these intangible assets to other entities. This allows the original creator to benefit from the broader application and commercialization of their innovation without needing to directly manage every facet of its production or distribution. Licensing agreements, often structured to provide royalties based on usage or sales, ensure that the intellectual property continues to generate income over extended periods, often far exceeding the initial investment in its development. This passive income stream, derived from the clever leverage of abstract creations, underscores how wealth can be cultivated through strategic foresight and the continuous exploitation of intellectual capital. Now, let's delve into the evolving landscape of talent acquisition and retention as a critical, yet often overlooked, driver of sustained economic value. In today's knowledge-based economy, a company's most significant asset isn't its physical infrastructure or its financial reserves, but the collective expertise, creativity, and dedication of its human capital. Consequently, the sophisticated strategies employed to attract, develop, and retain top-tier talent represent a continuous investment in future prosperity. Consider how leading organizations are moving beyond traditional recruitment to cultivate robust talent pipelines, offering comprehensive mentorship programs, continuous learning opportunities, and flexible work arrangements. This proactive nurturing of human potential ensures that the organization possesses the specialized skills and innovative drive necessary to adapt to market changes and seize emerging opportunities, often capitalizing on the latent potential within their workforce during non-peak hours. Building upon this, let's examine the strategic implementation of corporate social responsibility, CSR, initiatives as a long-term value enhancer, distinct from simple philanthropy. When a company integrates ethical labor practices, environmental stewardship, and community engagement into its core operational fabric, it cultivates a positive brand reputation and fosters deep-seated loyalty among stakeholders, including employees, customers, and investors. This cultivated goodwill acts as a powerful, albeit intangible, asset that can translate into increased market share, preferential regulatory treatment, and a stronger ability to weather economic headwinds. The consistent demonstration of commitment to societal well-being, often communicated and reinforced through ongoing public relations and transparent reporting, builds a reservoir of trust that appreciates over time, independent of daily transactional volumes. Consequently, the increasing sophistication of predictive maintenance and operational forecasting in industrial and technological sectors offers another avenue for continuous wealth generation. By employing advanced sensor technology, data analytics, and machine learning algorithms, businesses can anticipate equipment failures, optimize resource allocation, and streamline production processes before inefficiencies or disruptions can impact output. This proactive approach not only minimizes costly downtime and repair expenses, but also maximizes the uptime and productivity of critical assets. The wealth generated here isn't through active intervention during standard operational hours, but through the intelligent foresight and continuous monitoring that prevents value erosion and ensures consistent, optimized performance, thereby safeguarding and enhancing the economic potential of physical capital. Conversely, let's consider the growing impact of circular economy principles in business model innovation. This paradigm shifts focus from a linear take, make, dispose model to one that emphasizes resource recovery, reuse, and regeneration. Companies designing products for longevity, reparability, and eventual recycling, or developing services that facilitate product-as-a-service models, are creating new value streams. They extract economic benefit not just from the initial sale, but from the extended life cycle of their offerings and the recovery of materials. This approach fosters a more sustainable and resilient economic model, where value is continuously generated through efficient resource management and the closed-loop system design, minimizing waste and maximizing the utility of every component. Furthermore, the strategic development and deployment of digital twin technology present a novel approach to operational optimization and value creation. A digital twin is a virtual replica of a physical asset, process, or system, which is continuously updated with real-time data. This allows for sophisticated simulation, analysis, and prediction performance without impacting the physical counterpart. By testing different operational scenarios, optimizing parameters, and identifying potential issues in the virtual environment, businesses can enhance efficiency, reduce risks, and extend the lifespan of their physical assets. This continuous virtual iteration and refinement process allows for ongoing improvements and value maximization, operating independently of the physical asset's active use cycle, thereby generating wealth through enhanced understanding and proactive management. Now, let's examine the transformative power of predictive analytics and risk management, a domain where foreseen potential financial pitfalls translates directly into preserved and enhanced capital. Instead of reacting to crises after they occur, sophisticated algorithms analyze vast historical datasets, market trends, and even geopolitical indicators to forecast probabilities of events like market crashes, credit defaults, or operational failures. This foresight enables institutions to implement proactive hedging strategies, adjust investment portfolios, or fortify operational safeguards before adverse conditions materialize. The wealth preserve here is often invisible. It's the capital that doesn't evaporate due to unforeseen shocks. This continuous, data-driven foresight acts as a silent guardian, ensuring the stability and ongoing growth of financial assets by anticipating and mitigating threats. Further delving into the financial sphere, consider the impact of algorithmic market making on liquidity and price discovery. In complex financial markets, specialized firms employ high-frequency trading algorithms that continuously place buy and sell orders for various assets. Their profit margins are razor-thin, earned from the tiny spread between bid and ask prices. However, their constant presence injects liquidity into the market, making it easier for other investors to trade without drastically moving prices. This constant facilitation of transactions, happening at speeds and scales far beyond human capacity, contributes to more efficient capital allocation and price discovery, indirectly fostering a more robust and dynamic economic environment where wealth can more readily find its most productive applications. This ceaseless market participation ensures that capital remains fluid and available. Conversely, let's explore the strategic advantage gained through network effect optimization within digital platforms. While the concept might seem familiar, its nuanced application involves continuously refining user experience and incentivizing deeper engagement to exponentially increase the platform's value. For instance, social media platforms don't just passively host content. They actively employ algorithms to personalize feeds, suggest connections, and encourage interaction, thereby deepening user commitment. This intensified engagement translates into more data, more ad revenue, and a more defensible market position. The wealth generated isn't just from the initial user acquisition, but from the ongoing cultivation of these interconnected relationships, a process that operates 24/7 to strengthen the network's overall value. Moreover, consider the long-term economic implications of securing and leveraging intellectual property portfolios. Beyond simply patenting an invention, companies now strategically build comprehensive portfolios of patents, trademarks, and copyrights. This collective asset can be licensed, cross-pollinated with other innovations, or used offensively to prevent competitors from encroaching on market territory. The value isn't a one-time event. It's a dynamic asset that can generate ongoing revenue through licensing deals, form the basis for new product lines, or even be sold as a valuable strategic acquisition. This continuous exploitation and protection of intangible assets represent a form of wealth creation that is sustained and amplified through strategic management and legal foresight, operating as a persistent source of potential value. Finally, let's examine the impact of smart contract automation in decentralized finance DeFi. These self-executing contracts, deployed on blockchain technology, automate complex financial agreements without the need for traditional intermediaries. Loans can be disbursed, interest can be paid, and collateral can be managed based on pre-programmed conditions that trigger automatically when certain criteria are met. This removes human lag and reduces counterparty risk, allowing financial transactions and wealth-generating activities to occur seamlessly and securely around the clock across global time zones. The efficiency and transparency offered by DeFi protocols mean that capital can be put to work in innovative ways, generating returns and facilitating economic activity continuously, a testament to how technological innovation is enabling wealth to accrue even when direct human oversight is minimal. Reflecting on this extensive journey through the annals of progress and the subtle mechanisms of wealth, one can perceive a profound convergence of disparate elements. We've journeyed from the tangible heft of ancient bullion to the ephemeral yet potent currents of digital capital, traversing eras marked by grand empires, industrial revolutions, and the digital ages on the present network. The common denominator isn't merely the pursuit of riches, but the underlying momentum that propels its growth and transformation. It's akin to observing a vast, intricate ecosystem where every component, from the smallest microbe to the largest predator, contributes to the overall vitality and ongoing evolution of the landscape, often in ways that are not immediately apparent. The initial impulse to mine and hoard has, over millennia, blossomed into a complex interplay of innovation, strategic foresight, and the relentless march of time, all contributing to a continuously unfolding narrative of accumulation and advancement. In light of these interwoven insights, the path toward a final understanding becomes illuminated, not by a single beacon,